All right, welcome back to the show. So we got a really special guest today because he is a millionaire when it comes to the BRRRR strategy, a very popular strategy when it comes to real estate investing. So for new real estate investors out there who want to build a more $1 million portfolio and beyond using the BRRRR strategy, we have the guest for you today. So Darius Kellar is our guest. I'm going to bring him on and have him kind of introduce himself a little bit. But Darius, welcome to the show, man.
Oh, thank you. Thank you.
Yeah, yeah, no problem. So just kind of for our listeners out there, who might not know who you are, I know you've been getting on a lot of podcasts recently, so they've probably seen you somewhere, probably on the Bigger Pockets forum. But for anybody who don't know your background and don't know who you are, would you mind just kind of introducing yourself a little bit, talking a little bit about what got you started in real estate and how your story came to be?
Yeah. My name, like I said, my name's Darius Kellar. I started in Pontiac, Michigan. Struggling originally, just come from a struggling background. Didn't have much of a spoon fed type of start. Like I mentioned previously, I was living in a 2-bedroom house with a total of 7 people, including myself, and I totaled my car, kid on the way. I was also a janitor for 10 years, so I kind of know what it's like to start from nothing. And I essentially utilized the BRRRR method to build my, to do my 10 deals. And still today, I still have, like I said, 9 properties. They're all 8 of them are rentals, 1 I live in. I also use the BRRRR strategy to scale the properties, which I get into more as the show goes.
Yeah.
But that's a brief background.
Yeah, that's awesome, man. So you started really, I think a lot of people think, they're starting from a difficult position,
Yeah.
kind of in their business. But, you look at compare their own background to yours, they're not starting from such a difficult position, right? Kind of hearing about some of the stuff that you have to go through to get started. So kind of the question just starts, right? So how did you get started investing? Was that something you've always wanted to do? Or was it just one of the things that you kind of gravitated towards as you were trying to figure out ways to get out of your a little bit more difficult situation?
Yeah, so my situation was different. I was looking for a way to survive more so than just looking for a way to cut my living expenses. So during 2014 is when I bought my first property. The market was still kind of distressed. The prices, the city of Pontiac was, and what I did was I saved up $10,000 between tax return, savings. Like I said, I was living with other people, so my expenses was cut, so I could allocate those funds into my first property. But my first property was only like $9,000. So there was like it was totally it wasn't a full remodel, but it was it was like I needed to put the mechanicals in, the plumbing in. It needed like new floors. So there was quite a bit of work in that first property.
Yeah.
Um
Yeah.
so after after I got into my first property, I didn't know a lot. I didn't have a lot of the skills to repair the stuff. I ended up meeting somebody named Cerrone Cathy, and what happened was he kind of showed me some of the harder trades, like the electrical, the gas trades, and I utilized them skills on that property and my second property, which is like a couple streets away from my first. So my second property is only like $2,500, which is my most valuable property today. It's crazy because the laws have changed in Pontiac, and they've knocked all the blighted properties down. So anything that's abandoned or boarded up is single family wise is down, which made an incredible change to the values and the demand on the properties. So, after I did the second property, like I said before, the second property was very tough to remodel because the city jumped on me with the permitting and stuff. Times really changing during that time. And it was around 2015 to 2016. It took me 2 full years to remodel that property straight through. Like it was a total, like I tell everybody, you know, when I walked in the property, I could see the sky. It was raining inside. um, uh, so that was like really like my foundational start with the skills, and just learning how to, you know, using bigger pockets, just learning how all the real estate thing go. But like my intentions were not to invest in real estate. My intentions were to survive and cut living expenses. If I buy the, for example, if I buy this house for $10,000, then I don't have to pay rent, you know?
Mm.
So like rent back then was like $550 to $700. But when you're a janitor only making $10 an hour and still in college at the time, that's really a lot of, that's a big chunk of your income every month, you know? So that's the kind of thought process I had going in to buy my first home.
Yeah.
Now, go ahead.
Yeah, so I was gonna ask basically like, so when you were living in that first home, so you were living in it, right? So it wasn't just like an investment property. You bought it just to live in it to try to cut down your expenses.
Yeah, yeah. I mean, even family, you know, my family members moved in with me in their first home, and I actually moved them into the second home I bought. So I didn't even rent it out to like, you know, really capitalize on the situation, you know. When I got to my third properties, when I started using, like I used a home equity loan.
Hmm.
It's just a 10-year loan from the credit union. I used that to get into my third property, which I bought from auction.com. And I overspent on that property. I think I bought that property around 2017 at the time for about 35 grand. And that property today is probably worth about 150,000. Like, so just give you an idea, Pontiac previously had a stigma to it. It's
Hmm.
like the baby Detroit. It's like 35 minutes outside of Detroit. And if you lived in Pontiac, you know, you were known to go to a bad school. You were known to, you know, come from a rough neighborhood, that kind of thing. So that was like the stigma with Pontiac. It wasn't that great. So if you were buying a house in Pontiac, you were really looking down upon. And like I said, I was humble enough to just, you know, just try to like survive. I wasn't looking to hit a home run, but looking, you know, back, I was hitting a home run, you know.
Right.
Um, so you know, that's like I said, the third property I got in 2017. In 2018, between 2018 and 2019, I bought a condo. I bought a condo, and I used, like, I was still, you know, experimenting with the refinancing methods.
Hmm.
And what happened was, uh, I used the 30-year cash or refinance to secure the condo. That was essentially turnkey. So I was able to move tenants in right away, rent it out. But with the HOA, those kind of things, I had to sell the condo. So the way I sold it, I set myself up real good. I ended up renting that condo out for about a year and a half or so. So I made some kind of, you know, good positive cash flow from it. I put a HELOC on the condo, and I bought another single family property, which is my fifth one at the time, right? And I sold the condo with the HELOC on it, with the debt on the property. So I was able to escape a lot of the capital gains from that deal. Okay.
Yeah.
Now, when I bought that fifth property, I bought it at a discount. So it was from a wholesaler. The wholesaler got it for like 10 grand. I bought it like for like 42.9, and it was like only like 5 grand of worth of, you know, rehab, repairing the property. So I ended up renting that property out. And man, it's like the luck of the draw. That property is worth over 150 as well today. In fact, University of Michigan actually owned the lot behind me. So it's crazy.
Yeah, that'll put the price up, right? That'll
Exactly.
appreciate the
Yeah,
price.
exactly. Um, you know, just going further into the story. Um, so at that point, prices were so high that, because I couldn't really like buy more properties. I couldn't scale. But the good thing um, is that I understood what I needed to do. I had enough equity in the properties. I knew that I had a possibility of scaling if those properties, went up higher in value before I pulled all the equity out. Okay. And so I didn't just lay down and just stop investing at that point when the prices peaked. And another reason why they peaked is we got some big companies to come in to Pontiac. We got Amazon, General Motors was already here. We got United Shore Mortgage. We got, Lee's Construction was already here. So a lot of the companies really, took off on the commercial end when Amazon showed up, as well as the value. So I started to see like the land contracts started, owner financing started to diminish. It was less owner financing when Amazon showed. There was a lot of even though the values didn't change, the balloon up how you would expect right away. A lot of the things were taken away from us as investors. Like I said, the owner financing. I'm just trying to paint the picture clear.
Right. Yep.
Right. So, like I said, my goal was to scale. I wanted to get somebody told me they had 40 properties. I wanted to get to 40 single family properties, And what I did is I went back and increased all my rents on all my properties. So I made sure my portfolio was efficient. Then I pulled all the equity out, and then I went to Flint, because I knew when I showed up in Flint, I could buy packages of properties, right, at discounted prices, because I seen it coming already, that the values in Flint were going to take off. But I also was looking at it, from a good sense of an investor, where, okay, we have the eviction ban, we had a water crisis that banged Flint. So I'm thinking like, okay, cool, I can go and buy these properties dirt cheap, which I did. I mean, when they said that second eviction ban in 2021, I bought 2 properties out of the Genesee County Land Bank, and I bought 2 more from MLS during that time. So that was like 4 properties in 2021. And then that closed out in 2022. I bought another one in Pontiac. So, so the trick is to scale with the single family is that you gotta pull the equity out of the properties simultaneously. You see where I'm going? Right. People like to you can also refinance them as you go, but you're when you're refinancing them, you're also eating the rabbits. Is like what I try to tell people. You're making more rabbits, but you're eating the rabbits. You got to make the rabbits quicker. You got to pull the equity out real quick and then go spend the money. You see where I'm going? So in that time frame, just from those few properties, I pulled over $250,000. So that's what I was using when I went to Flint. And let me give you an example. When they say the eviction ban, and when times are distressed, when you're turning on the TV, and I was thinking smart, I was thinking, okay, I'm about to go buy me a remodeled property in Flint that's low risk, and I'm gonna rent it out. But I'm buying it at a discounted price because the times are bad, and it worked out. It worked out great. I got a fully remodeled crib for $35,000, and I'm rented out for $1,000 a month. You see where I'm going? Yeah. That's great. That's a great return, especially with today's rates being like 3%. So, so that's essentially just a nutshell how I was able to scale. And to scale again, the plan is to pull the equity out of all the properties again, or as many as I can, all at one time or simultaneously, and buy another package of homes and then remodel them all again. But the key is that when I'm buying these, I'm not just buying them, I'm buying them at almost zero. So when it's time to refinance, I'm pulling, I'm really squeezing all the equity out. I'm really getting a good amount of change. my
Good
average,
margins, right?
yeah, exactly. So like an average refinance, I'm looking at like 60 to 80,000, which is a
Wow.
pretty significant amount of money when you're talking about, and that's really not that's not a crazy, that's a reasonable value. That's not nothing crazy. That's not like saying that I'm buying a house at 20 grand, the house is like 200,000. I'm not saying that, no. 80,000 is really not much to ask for. I'm using low numbers when I'm doing my calculations. You see where I'm going?
Mm.
Right.
Yeah. Yeah, so that makes a lot of sense. And I think, just to kind of clear up for anybody listening. So what you're doing is you're pulling the equity out of all of your properties, right? So like you said, you started out with a couple, I think you mentioned 10, and then you would pull out the equity out of all of them so that that way you have a larger amount of cash.
Yeah,
And
yeah.
that way you could purchase more properties for even lower price because you're doing it a package deal, is what you're saying.
Exactly. So like I said, in the future, like now I'm at 10 I'm at, 9 properties total now. So once I complete the other 3,
Mhm.
source those, make sure the portfolio is efficient, then I'll squeeze the equity out while the market's still good. And then I'm going to go buy again. I'm going to go buy another
Right.
package. But when I bought those
Right.
first 4 properties, they weren't just any properties. I bought them strategically. One of the things I did is when I was studying the properties, I was looking at the previous mortgage, because that let me know at one point in time an appraiser came by and said this property is worth, 150 grand, or whatever the case is. So they gave me an idea that there is a chance that this 20 grand property will balloon up in value. You see what I'm saying?
Right.
So, I was kind of looking ahead of time, so at least once I started to get a groove, after
Mhm.
like my 3rd property, I was really, trying to see if I can make some money on this thing. So, yeah.
Right. Yeah. So that makes a lot of sense. So, I mean, kind of just going back to like the beginning. So the first 4 that you bought, did you do them one at a time or did you do that all kind of as a package deal as well?
Yeah, yeah. So the first 4 I bought, like I said, the first one I was just trying to survive is I bought it in 2014. The second one I purchased in 2015. Um,
Mhm.
Third, it was like 2016 auction.com, and then 2017 to 2018 I bought a condo. I sold the condo and bought another one in like
Right.
2019. So ended up getting rid of the condo, but I kept all the single family homes.
Got it.
So yeah.
Yeah. And for those ones, you were doing kind of like you're doing the BRRRR method, or were you buying them kind of not using refinancing strategies? I think that was what I was trying to ask. Did you refinance your first property to get your second one, to get your third one, and then your fourth one, or were you kind of using just
Right.
cash or other financing sources on the first 4 just to get started, right?
Right. So with the first 2, I bought those straight, cash out of my pocket. I went
Okay,
from
yeah,
9,000, and then my
right,
second one was, $2,500. I mean, anybody can pick up $2,500,
right,
these days, right?
right.
And then I bought when I got to the 3rd property is when I used like a home equity loan, and
Mhm,
that's how I secured the 3rd property. So I used my primary residence, just got a regular, 10-year loan on my house,
mhm,
and it's just a cash loan. And then I purchased the 3rd property with that. I was, bidding blind in an auction. So
right,
that's essentially what auction.com does to you,
yeah,
So you got to be brave, you
mhm,
got to be brave when you're bidding. You can't be shy. You gotta buy when there's fear.
mm,
Um, these people now, they want to, look at the data, look at the appraisal. Back when I was investing, you didn't have all the data. The home paths, Zillows were completely different than what they were today. Now, you pull up Zillow, you can see, almost, everything. You can almost see MLS on Zillow. Zillow's almost comparable to MLS these days. So, uh, yeah. So, when I was buying in 14 to 2016, it wasn't like that. It was hard to even find a realtor. Now, I mean, you can't get away from a realtor. So,
there's more realtors out there than there is non-realtors. It almost feels like. So
right, right,
yeah.
right.
Yeah. So I mean, kind of like back in the day, right? So what did you do to analyze those properties? Were you just kind of buying off of like so what went into the actual analysis of the property kind of for you when you were looking at some of these, these houses that you were buying?
Okay, so yeah, so like when I was first buying, I was buying again okay, when I was looking at the house, I was like, okay, this house has a new roof. It has a decent exterior. Okay, I know somebody who does drywall.
Mm,
You know, at least I can at least this looks like something I can handle.
right.
When I bought the second property, I was like, oh, these properties are going so quick. I can't lose them buying a property at $2,000. That's nothing. You know, some of these guys spend $2,000 in the club. You know what I'm saying?
Right.
So, I mean, I was thinking from that kind of sense. But when I bought my third, I was, like I said, I was looking at the previous histories of the mortgages for that property, you know, because history kind of repeats itself with real estate. You
Mhm.
know, real estate comes in waves, right?
Yep.
So that's how I was looking at it from that sense early on. And then when I bought my fourth property, I was started to break the numbers down, right? I started to
Right.
say, you know, look at my mortgage, my taxes and insurance, um, um, adding my 5% in maintenance every month,
Right.
that kind of thing. So I was really analyzing the deal from that perspective. But I also was see, I'm a guy who looks at like I look at the property and the benefit of three. So, you know, you're paying the debt down, right? But you're, you know, you want that property to balloon up in value. So when I'm buying it, I know I'm confident that the property is going to balloon in value because it's I'm buying it cheap, right?
Yeah.
And then the cash flow, right? So the positive cash flow after the expenses. So that's
Yep.
you know, the third way you're kind of making money from the deal, right? So
Yeah. That's really smart. I think, I don't, you mentioned, kind of looking at the mortgage history. I don't think that's a very common strategy a lot of people use today. I think it's probably missed. So that's a really good strategy.
you know, another thing too is the so people when people look at appreciation, they're not I tell people to break that down, okay? So look at the appreciation of the materials. How are the materials going to appreciate? And the way I do that is by looking at the total square footage of a property that's new listed for new construction in your area. So if you're looking at a brand new property and it's listed for $200,000, right? It's at 2,000 square feet. That's $200 a square foot, right? I'm sorry, $100 a square foot,
Yep.
right? So
Yep.
2,000 square feet times $100 a square
Right.
foot puts you at 200,000.
Yep.
Okay, and so so example. So what that does is I take that equation and I compare it to the property that I'm buying now.
Mhm.
So if that property is 1,000 square feet, I'll take that new construction cost and I'll multiply it to the existing to the square footage of the property that I'm buying. And that'll tell me, like, just from a material standpoint, how much is that property going to be worth? You know, you see where I'm going? So
Yep.
regardless of the location or where it's at, you see what I'm saying?
Yep. Yeah, that makes
So
sense. Mhm.
right, right. So that's another way to look at a property if you're like from out of state, you don't know the area well, if you're just looking at it just from the material standpoint.
Right. That's great. I mean, I think that's a great piece of advice for a lot of people because I think a lot of investors or people who are a little bit newer who don't want to risk too much. There a
Right.
lot of excuses like they don't know how to analyze, they don't know if they're getting ripped off and if it's going to be a good deal or not. And just by looking at like existing new construction properties to essentially use that same formula to predict the appreciation of the materials. Because I mean, really, in all honesty, that's kind of what aside from location, that's what the property is worth, right? It's just accumulation of the materials and the
Yeah.
land. So just kind of looking at that, you can almost predict what what this property is going to be worth, in the future as well. So I think that's a great piece of advice just for anybody kind of who might be a little bit lost. But
Right.
and there's also very good comparable new constructions in the area as well. That's a great way to use something that you can find just out there on the internet without having to pay for prop stream or all this
Exactly.
kind of fancy calculators. You can just kind of use that as a measuring stick for whether or not it's going to be worth your investment.
Right. Right. You know, and I'm not looking at the properties like I said, my ugliest house, the cheapest house is worth the most. And
Right.
it's simply because number one, the laws changed. Like for example, when I mean laws change, the city of Pontiac, you can't purchase open lot anymore from the city of Pontiac without without any plans to build on it. So you have to have active plans to build it if the city is going to sell it to you. So what that did is that made it harder just to wake up and buy lots in Pontiac. And it gave the, you know, the land that you do currently have, it gave it a, you know, a higher value because of the demand, right? The supply,
Yep.
like they're holding out. So that really helped. But you know, I'm looking at the houses like money machines, right? And in people who are new to investing, they can't look at the home as, oh, if they're gonna live in it, or if they're, you know, if the carpet's nice, you know, it has granite countertops, you know, I can care less. I'm looking at, okay, how much is this thing gonna make me at the end of the
Yep.
day, right?
Right.
Exactly.
Yeah, it's a business transaction. You can't look at, from an emotional standpoint.
Yeah, and if you know, if you know the addresses of your house, of the houses you own, that means you don't own enough houses. Bottom line, you know, like if you know where they're located, you don't own enough houses. Bottom line. So
Yeah.
yeah.
Yeah, man, I love it. So, I mean, a couple questions I think a lot of people will have. I think these are probably the two. Well, this one's probably the most common that I hear from a lot of people who are looking into the BRRRR method and who don't really know what to do or they haven't taken action yet. And it's really just, what goes into refinancing, right? They kind of want to figure out just the sequence of events, right? Should they? Because a lot of them do use like hard money or some type of loan or like private money loans to try to get into these properties or even cash. I think cash is a little bit easier, kind of like the way that you started, because you don't have to kind of worry about like the super high interest rates. But for the refinancing process, so what were some of the products or the loan products that you used, and do you think it can be kind of easily translated to anyone else, in any other market? Were they like asset based loans? Were you going to local banks, and kind of what was the sequence of events when you were trying to get refinanced out? Did you have to get it locked in place before you bought the second property, or was it more like you kind of just trusted and had faith in that it was going to happen?
Yeah, so I use all traditional style
Okay.
loans. Like I said, the HELOCs, the home equity loans.
Oh.
The difference between the HELOC and the home equity is that the home equity loan, term loan, is just like a fixed term. HELOC's more like a credit card type of use.
Right.
The cash or refinance and the spread out over 30 years. I use that in the conventional mortgage. That's all traditional style loans. Interest rates, I'm not too concerned with interest rates too much, too much. I mean, as long as it's below 8%, I'm pretty happy with it, personally. I have used credit cards as well. That's also assisting me with repairs. And I bought a house off of utilizing a credit card. So there are some limit credit cards out there that you can use that act like cash, so you can
Right.
buy and secure a property. And I like I said, I use those in an auction setting. So um the sequence, as far as the sequence of how I use a loan. So when you're setting up your portfolio, it's a lot easier when you're using cash to secure the first couple properties, or at least the first property,
Right.
because because what happens when you purchase that first property cash, you're pulling that equity out and you're going to use cash for the next property. But the cool thing about the cash is you have the ability to, you have the flexibility of waiving inspections, waiving appraisals, guaranteeing that you're going to, close on the deal very quickly. So those are the kind of, good things you can do when you have cash. You can also use a conventional loan as well, but it's a little slower, right? You can still
Right.
waive the inspections and stuff. But you're limited. Like you can't go on the auction, at least the auction.com, and use a conventional mortgage.
Right.
You just can't do that.
Right.
You can't go I go to the Genesee County Land Bank to buy properties. You can't use a conventional mortgage to buy a property
Right.
through them.
Yeah.
So you need cash, or like I said, use a credit card.
Hmm.
Um, now, when I'm in an open market, when I mean open market, I mean Zillow, Redfin, MLS. I play the communication game when I'm trying to buy a property. So I'm having my realtor, my investor friendly realtor, call the listing agent or for the seller, and I'm trying to see why they're selling the property, not
Hmm.
why based on, okay, the roof is old or they don't like the property. I'm looking for the why, like the emotional why, because if I'm trying to get them to get that price down, you see what I'm saying?
Yep.
And people tend to bring the price down significantly based on their behavior and their emotions when the property's in the open market. Okay. When the property is listed on an auction site,
Right.
I can't go talk to the seller, right?
Right.
I'm limited to just the property, the physical aspects of the property, if it's deteriorated, if it has no electrical in it. You see what I'm saying?
Yep.
So that's how I'm bidding strategically that way. But it appears when I call the seller and I play the communication game for the property that's listed on the open market, it appears every time I'm able to get a really good discount on those properties.
Mhm.
You see what I'm saying? Because if you
Yep.
call the seller, if a property's listed on Zillow, 100 people are looking at that property, you all are looking at the same thing, but there's very few who are going to call that seller
Yep.
and see exactly what's going on. Maybe seller might want to move away out of state, or maybe, divorce. That's what you want to look at, because you may be able to fix a problem, um, you may be able to fix a problem that you can solve for them.
Right.
So, and you may get paid for that, solving that problem. So that's what I mean too, as well, by look for problems.
Right. Yeah. Because sometimes, like you were mentioning, like divorce, like sometimes they have to sell it, right? But you don't know that until you actually communicate with them and listen to them and find out the reason behind why they have to sell it. So that's very good. I think a lot of investors need to develop that skill set as well, especially if they're going direct to seller, MLS, different things like that. So
Yeah.
yeah. So kind of the other question that I had, I think most people will be interested in is you just using credit cards and line of credits, right? So I think people might hear this and they think, do I need to have like perfect credit for this? What if my credit's not so good? How can I go out there and get this? What are some of the potential risks? And kind of explain that process as well.
So when I'm using the credit card, so anytime I take out debt, I'm looking to make more money.
Right.
You don't take out debt, to not make more money, right? So when I'm using a credit, the cool thing about credit cards is um you're not spending anything until you use. You're not making a payment on
Mm.
nothing until you use it. You see where I'm going?
Yep.
So you're not being charged interest until you actually go and use it. Just like the HELOC, it works the same way, right? Just like the credit card I'm talking about is like a regular standard 5-year credit card versus a HELOC.
Mm.
They're used the same way, just the terms are different. The length is different on the payments, but it allows me to get ready, stay ready at all times, because I don't know when they're going to list that good property, that's a really good deal in the auction. I have like every week in the Genesee County Land Bank, they're listing new properties, just like auction.com. Every day there's a brand new property on auction.com, but you have to stay ready for opportunity. And the credit cards really allow you to stay ready. As far as interest rate, you don't need the interest rate. Interest rate only relates to your credit score. So if you have a good credit score, it'll get you a really good interest rate. It's really the income is what's going to allow you to have a high limit on the credit card. Okay. The HELOC is against your is more so against your home. It's secured, but that 5-year standard credit card is like a signature loan. It's more so just unsecured cash.
Right.
So but that's why I'm using it, so I can highlight an opportunity. So if you already have, say, 50 or 100,000, you go add 30, 40 grand in credit cards. Now you're turning your 100 grand into 150 grand of cash to go secure a property. And then once you secure that property, you can refinance that property and pay those credit cards back. off to zero, because you don't want to pay no credit card. It's
Right.
lethal.
Yeah.
So that payment is high.
Yes. Yes, it is.
Right, right. Where you can do a cash or refinance for 40 grand, and your payment's like $200 a month. So, right.
Right. Yeah. And I think that's where I think a lot of people, you know, get held up is, again, I don't think they understand. So like, would you say like I wouldn't say like everybody can go out there and get it, right? But like, would you say like most people will be out there and kind of use this same strategy, either HELOC if they own a home, or, get like just the credit card and kind of use that and just be prepared to buy properties?
Um, I wouldn't say most people shouldn't do it, because you have to be disciplined,
Yeah.
um, and you have to be poised, right? So, like I said, you have to be poised to, okay, I'm going to get these credit cards, but you got to understand the goal that's in mind. And the goal
Hmm.
that's in mind is to secure that property utilizing cash. That way you can buy the property as close to zero as possible, buy at a discounted price,
Hmm.
right? So, when you're and another thing too is that, yeah, the credit card rate is high, 8-9%. That's considered high for a credit card, but in today's market, but it's actually not that bad if you're comparing it to like a 30-year cash refinance, because on a 30-year cash refinance, you're paying like 4,000 to 6,000 in fees just to
Hmm.
secure that loan. And you're going to be charged day one when you get that loan. You see what I'm saying? You're just using the credit card as a quick day of leverage just to
Hmm.
secure the property, you know?
Right.
So, but everybody shouldn't use it, because it's people don't know how to, people are not disciplined. They don't understand what the method, why you're using it.
Right, exactly. So you're only using it as like you were saying, like leverage to, so that you can get the refinance and then pay it off, right? So because not everybody has that cash lying around. So that's just one other method to get into the property and then immediately refinance. And then that way you're not burdened with that, the credit card debt.
Exactly. And I honestly think the credit cards are far better, even the hard money loans,
Mm.
because the hard money loans, I mean, many of the companies I've seen, they want that 10% fee of the money that you're borrowing, you
Right.
see. And some companies for hard money, they're limiting you to the properties that they've already evaluated to purchase. They're not just giving you the hard money. You just, walk around and you just find, you wait on a deal. The credit cards, I can do whatever I want with them. You
Yeah.
see what I'm saying? You have a lot more
Right.
freedom, and you can call your own shots, right?
Yep.
So I'm not going to put my hands into the another firm's control, put my, put
Right.
my money in another firm's control. I'm going to try to put my deal in my control.
Mhm.
So that's how I kind of look at it. Um, and it works very well.
Right. Yeah. So that makes a lot of sense. And so the other thing I think is pretty interesting that you brought up earlier is buying package deals. So just to be clear, you were buying like these two or three properties together as a package deal.
No, no, I was buying them. I was buying them just simultaneously. Like, I go on the auction
Got
and
it.
I buy two that I bid on two that day and come out with two of them. Or I
Okay.
go to MLS and I submit offers on like four houses and I end up with two. So
Okay.
that's how I was, purchasing them. I'm not just submitting an offer on one property at a time. I'm submitting like three
Got it.
offers, because I'm ready for people to say no, because I'm bidding so low, on the
Right.
properties. So,
Yeah.
right.
Right. Yeah. I heard that, from another investor that if you're not bidding, if you're not like risking insulting the seller, if you don't feel embarrassed by the amount you're offering, you're not offering low enough. You're offering too much. That's what I heard as well. So
No,
yeah.
that's good. That's I understand. See, I don't have a problem overbidding either. I don't have a problem overbidding. If you really know the property well, and you know the area well, like the rent, how it's going to cash flow, what it's going to do in the future, then why not overbid? So there's been times where I have overpaid for a property in that current state. You
Right.
know, but like I said, the property has appreciated over time, so very well. Um, another tip here I can give to the viewers is that managing the property. How the heck do you manage nine,
Right. Yeah.
properties at once, self-manage them. And so I do self-manage the properties. It's not that difficult. If the properties are taken care of, I only spend like an hour, a month dealing with the properties. If the roof needs a patch, pick up the phone and call the roofing company. It's not that hard. If a tree needs to be knocked down, call the tree company. It's not that hard,
Yeah.
But I use apartments.com to handle majority of the load for me. So apartments.com is free. You can collect rent on it. You can handle the applications on it. Even the maintenance requests can come through apartments.com. It's just the only catch with apartments.com is that there's after 15 properties, I would say that's the limit. Once you get to 15 properties with auction.com, it becomes very difficult to manage the properties on there because you have so many water bills, so many payments at that point. You need your own proprietary website, your own website for your units after 15. So
Yeah, so that makes a lot of sense. I think a lot of people are held back by the idea of self-managing. They think it's going to be a lot of work, but kind of like from what you're saying, right? It's not. People I think are just overcomplicating it, and they haven't given it a fair shot yet before they just write it off.
Yeah. Trying to think. Do you got any rentals yourself?
No, so I don't currently actually own any rentals. So I'm just hosting a podcast.
Okay, no, I mean that's
Yeah.
fine. I personally think that real estate is slow. I don't think it's. I'm not.
Right.
I don't like it as much as people as you would think. As many houses I have, right?
Right.
It's slow. I think waiting 30 days for a paycheck is stupid. I think that it's hard to scale, right?
Mhm.
I think it's a lot better to go into more of the product side of things, because you can make $1 million in a night, right? On the product side. So I think real estate is just far easy. I mean, it's very easy.
Right. Yeah.
And
It's just one of those things where you don't have to reinvent the wheel.
exactly. And people are out here and willing, there's more than enough money for everybody with real estate. You don't really have to worry about competing with a lot of people. So
Right.
yeah. Another thing too, now I'm trying to help people. I'm trying to help people not make the mistakes that I've made.
Right.
One of the biggest mistake I've made, I always say it, is that my $2,500 house, the most valuable home I have, was my biggest mistake. And the reason why is because when I purchased that property, at that time, the prices of the homes were like 10, 20,000 at best. Okay. And after I sat there and tried to fix up the property for 2 years, do the Dave Ramsey trick, no
Right.
debt, go be a janitor, drive your little putt to work, come home, fix up the rental property. That after 2 years of remodeling the property, what happened is the market changed. And those 10 to 20 grand homes were now like $50,000 plus easily in just that 2 years of time. So the Dave Ramsey trick didn't work. Having investing in a property with your cash, doing it slow, having it paid down to zero, it sucks. Okay. Because the speed matters. When I'm burning these properties, I'm not going no longer than 6 months. 6 months is the longest I'm going on a property. I might not even buy the property because if it takes me longer than 6 months, it might not even be worth my time. Because if your rent is $1,000 a month and it takes you 12 months to repair a property, that's 12,000. Opportunity right there. You see where I'm going? Not including the market's changing in 12 months. You see what I'm saying?
Yeah.
I mean, you can't even, you could barely use those comparisons after a year. You can't, you see where I'm going? So that's why when I'm burning these properties, I'm like, I see the property, I buy it at a discounted rate. I know that the property is going to be worth at least X amount of money. When I refinance, it's going to appraise X amount of money. I'm going to refinance, and then I'm going to go to the next property and do the same thing. But the best situation with a BRRRR is for you to get 100% of your money back. So if you put in 60, 70,000 into a property, you want to get 60 or 70,000 back. That's the best situation with the BRRRR, or just a little bit more than what you put in.
Yeah.
You know, sometimes I see people, they do a BRRRR, and what happens is they put 60, 70,000 in, and they only get like 30 grand back. That's really not worth it.
Right.
Right.
Yeah, that defeats the entire purpose of it.
Exactly.
Right.
With that being said, you can get mortgages below 40 grand. People think that you can't get mortgages below 40 grand. It's very possible. I have mortgages, but I have a mortgage that's like 34,000. So it's possible. And a recent mortgage too. It was like 2022. So
that's about as recent as it gets.
That's as recent as it gets. So you can definitely get mortgages below 40 grand. The banks don't like to do it. It's not a big benefit to the banks. I understand. But there are banks out there that will do it. So
right. Yeah. So and these mostly are like national banks, or have you noticed that like maybe like the smaller bank are more willing to kind of extend that offer?
Huntington's national. So yeah, Huntington does it. Yep.
Okay.
And you can get I mean, I know people who have 90 mortgages, so you're not limited. There's banks out there that will give you 90 mortgages. You know, I laugh all the time about that point, because I can only imagine what it's like to refinance a house when you have that amount of mortgages, because of all the paperwork you're handling.
Yeah. Right. Yeah. You just gotta be on the lookout for it. You can't limit your choices. You can't limit it just because one bank said no doesn't mean you can't find somebody else that, like you said, gave you 90 different mortgages.
Right. Yeah. I work a 9-to-5 job. So I have the nine houses, but I work like I said, I work a 9-to-5 job, and it's separate from real estate. It has nothing to do with real estate. Right. So people, you can work a 9-to-5 job and balance the real estate. It's very possible. I think the limit is like 7 homes. After 7 homes, that's when it starts to get kind of a little bit hard. Without somebody helping you manage, with your 9-to-5. But I do wanted to throw that out there. Like, and I mean, I do the 9-to-5 because it helps. It helps expedite everything. So I could just, walk off now, but it's not, my portfolio is going to slow down.
Right. Yeah. Yeah, absolutely. And I think a lot of people, one of the big questions I think people ask, like, how can I be a full-time real estate investor? And, it's by being a part-time real estate investor first. It's a business that you can run, while doing a 9-to-5 job, because, you don't have to reinvent the wheel. You don't necessarily have to be there 24/7, especially if you have somebody helping you manage. So this is something you can scale up in about, would you say like slowly, maybe 5-10 years, quick, like you've done it, a lot quicker than I think, most people even do it. So
yeah. I mean, one of the way I scaled up was a little bit different than what I was taught. There's another investor I was taught how he scaled up, and what he did is he bought like a four unit, and he refinanced that 4 unit to pay off the single families, and he was able to consolidate everything into one loan. So that's a good way of scaling in your how you say it. Sorry about that. That's a good way of consolidating everything,
right,
and then getting out of your 9-to-5 as well. So
just gotta kind of figure out what your own path is, and what kind of works for you as well. So awesome, man. Well, thanks so much for kind of sharing knowledge today, Darius. I really appreciated it. And hopefully our listeners got a lot of value out of it. Kind of take some of these lessons out there, apply it, and go out there, build their own BRRRR portfolios as well. But like other than that, I mean, is there, anything else that, if anybody wanted to kind of reach out to you, obviously you're pretty active on BRRRR. Is there any other like social medias that they can reach out to you on, follow you on, or any websites that they can kind of check you out and kind of some of the stuff you're doing?
Yeah, on YouTube, I'm the Darius the Investor. On Instagram, you can add me as a Darius _1 of 1 spelled out. And you can go to my website, rrrwithd.com. There you can sign up for the one-on-one private coaching or the one-on-one non-private coaching, where the non-private sessions are actually free. I use those for social media content. Those are working really well. People are benefiting from those. So like I said, you can go to rrrwithd.com, and you can see all the podcasts, including this one, on there as well. So yeah.
Nice, man. Well, I appreciate it. And we'll make sure to leave all the links down in the description as well so that people can find them.
Okay.
Other than that, man, is there any last tips, last nuggets you kind of want to leave with the audience here before I let you go?
Yeah, the biggest misconception with building a portfolio is people don't understand clearly how cheap the properties are being purchased by the investors. And even if the properties are listed, 200 grand, there are investors out there buying that same $200,000 property at 100 grand or $50,000. I'm seeing it today. So I just want that to be clear, that properties are being purchased by investors cheaper, a lot cheaper than what you would imagine seeing them on Zillow. And all of the data doesn't get recorded because sometimes people are selling the contracts to someone else for the property. So that middleman, like almost like a wholesaler, is getting their property at an extreme cheap price. So I just want to make that clear, that the prices are being sold a lot cheaper than what it appears on Zillow, Right.
Yeah.
That's it.
Awesome, man. Well, that's a great tip to leave us on. And Darius, I want to thank you again for being here on the show, joining us, and for our listeners joining in. I appreciate it as well. And we'll see you guys on the next show. Take
All
care.
right. Thank you. Bye.